How come wherever I drive, I see banks? And how come there's not enough millionaires that are in congruency with all the banks that are out there, especially with the savings accounts that they provide for us, although they don't give us much interest? Yet, the banks take people's money in over and over again, and they're building out more and more banks, whether it's online or on street corners. Well, today I'm going to talk about 3 reasons why you should not put all your money in a bank so you can live the life of financial freedom that you deserve. Why you should never keep your money in a bank. And my name is Rob Gill, founder, CEO of Epic Financial Strategies. And long before I had a net worth of 8 figures and long before I had an income of 7 figures, as I was on the come up, I began to learn what banks actually do. And as I began to learn what they do and how they do it, I started to model that in my world, which I'll talk about later on in the video and share those little trade secrets with you. The challenge here is to understand whatever status quo is, whatever direction everybody else is going, you can, once you have a game plan, once you invest in real estate between your ears, not do what everybody else does, not keep up with the Joneses. Heck, don't even know who the Joneses are. And by doing that and empowering yourself with education, with folks that can really share with you strategies that have been around for 200, 300, 400 years, you too can become the person that you want to be financially, generationally, when it comes to your money, time, freedom. And I look forward to sharing that journey with you today. So as we jump into why banks don't work for you, I'm not saying it doesn't work for them, but why it wouldn't work for you is because you have to understand is what is a savings account? And to me, I think of the insurance industry, the lost leader for the insurance industry, the mega producers for the insurance industry love term insurance because they never cash in on death benefits. Well, guess what? Banks love savings accounts. Why? Because they give you little for the money you put in there for the safety, even though it's being eroded right in front of your eyes, and they use that money on their balance sheet to do other things. So what is a savings account? It's an interest-bearing deposit held at a bank or a credit union. To take it a step further, accounts designed for holding funds intended to save, not for day-to-day transactions. So remember, you're not going to put money into a savings account and start paying your mortgage out of it, right? And as you understand that, banks pay savers an annual percentage yield as an incentive, and it is very low, to keep that money in there, limited to a maximum of maybe 6, maybe 5, maybe 7 withdrawals a month, so you can't go in and take money out every single day. And unlimited savings accounts withdrawals are allowed only when they're made in person via mailed request or an ATM. So there's a lot of little snags along the way in order for you to get access to your money, and then you really don't get a lot of interest for it. So let's say if you're getting 4% interest, right now inflation's at 7%, well, think about it. You're running east looking for a sunset. You're actually moving backwards. It'd be like if there's $10,000 right here and you're looking at it, you go in the spaceship, you come back 2 years later, it'll physically look like 10,000, but you'll be able to have 7,000 in buying power. That's no different than the small interest you earn in a savings account. It is losing money day to day against inflation. I know I just hit you with a lot, but we're going to dig deep into 3 specific reasons of why you should not put all your money in a bank. And number 1 is hidden fees. Federal withdrawal limits. I mean, it basically allows a limitation on how many times you could take withdrawals out per month. So let's say if the number is 6 and you do 8, you're going to get hit with a fee. An activity fee. Well, if you have direct deposits because you're in a commission job and all of a sudden you didn't make any money for a month or 2, you get penalized. What do you think about that? Overdraft fee. Well, I write a check out to Joey around the corner, Baby Jojo, and they don't deposit the check until 3 weeks later and hits my account 4 weeks later, but my money wasn't zeroed out the right way. All of a sudden there's an overdraft fee. Service fee, well, listen, I know that in the past I've had a savings account where it fell below a certain amount of money, even if it was $100, and there was a fee that I got hit with. Early account closing fee, insane, but that's a real fee. And think of all the people that this is happening to every single day with all the bank institutions that are out there. And last but certainly not least, we cannot forget about the international transaction fee. Of course there's going to be a fee there because as you move money, somebody's got to get paid. According to the New York Times, in 2022, if you think of all these fees that I just talked about, there was $9.9 billion generated for all the banks. I want you to think about that, and that's with a B. You know, when you go to a bank, they give you a lollipop because you're a sucker. And the point is, if you think about that, that number is insane. But let me take it a step further. Go back to pre-pandemic, and that's $15 billion. As I sit here and do this video, and we work through 2023, I suspect that we're getting back past 9.9 and heading back to $15 billion because the world is coming back now, and these fees, they're not going to stop. They're like a rapacious creditor. They just keep coming and coming like waves in the ocean. All right, folks, let's talk about number 2, which is interest rates. And this is the granddaddy of them all. You have to learn this now, and the sooner you learn it, the better decision you make when it comes to your money time freedom. Hypothetically speaking, you have a savings account, you put $100,000 in it, and it's annually earning 3%, which means that $100,000 is going to give you a $3,000 in interest. Now, that's in the fake world. That's not even happening right now. If you look at the real world, that same $100,000 in a traditional savings account as of today is going to give you 0.45. So not $3,000, but actually $450 on top of your $100,000. I want you to think about that. If somebody was going to take $100,000 and put it into a piece of real estate, which would earn 4, 5, 6, 7 different rates of return, instead they put the $100,000 in savings and get $450, and there's no tax benefit. And after inflation, it's going to be worth less than $100,000. Also, what banks can do in these savings accounts is, because the rates are variable, they could change on the fly. So what's 0.45 today could be 0.35 in a month, or 0.75. But there's really no stability there other than your $100,000 is going to stay the same, except it's not factoring in inflation, which right now is about 6-7%. Anyway, these are the things that's important for you to understand when it comes to exactly how to position your dollars in savings account. I always say it. Make sure you go with the first 3 months of fixed expenses, but after that, deploy that capital wisely. So number 3, opportunity cost, folks. I love this one. This is where, when I learned this game, everything changed for me, and I went into those 7 and 8 figures that I discussed earlier. Bottom line is this. Whatever money you have in a savings account, if it's earning 0.45, and that same money could be earning 8, 9, 10, 11, 12, or 20% somewhere else, that's the lost opportunity cost that you need to focus on. So think of it this way. We always hear about the greatest chart in history. And I'm not suggesting that you do it. This is just educational. But if you look at the S&P fund from 1980 until December 31st, 2022, the average, not actual, but the average rate of return was 12.2%. Versus 0.45, right? So if you think about that difference and the compounding effect of that difference, you're talking about multiple millions of dollars over someone's lifetime. Now, on top of that, if you're like, yeah, but I don't like the stock market, Rob, I want to do something different. Well, let's talk about real estate. Once again, real estate, if done properly with the right team, you're going to get 4 different rates of return. You'll get cash flow, right? Money while you're sleeping. You'll get a mortgage interest write-off, as well as depreciating the asset. Those 2 save money on your tax return. And last but not least, you're buying a property today to sell in the future at a much higher price. Now, think about what I'm saying there. In that scenario, I can't give you a rate of return. I've heard some people say it's 40, 50, 60. I know it's a lot higher than 0.45. If you really think about the money you're saving in taxes, as well as the cash flow on the rental, this is all money that's coming back into your pocket where it belongs. Once again, if it's all in a savings account, that's not going to happen. What if you could utilize a savings account mindset while it's still earning that rate of return inside that savings account, but now get these other rates of return in other areas? Stay tuned, because we're going to dig deeper into that as we go through this video. Before we get to the end, where I'm going to give you that surf and turf, and it's going to be really good, let's talk about, besides putting your money in a traditional savings account, where you should actually do it. It's a high-yield savings account. It's kind of new. A lot of traditional banks do not have it, but here's the definition. It could pay you up to 10 to 12 times the national average of a standard savings account. For example, if you have $10,000 in a traditional savings account, for argument's sake, let's say the interest is 0.33, that $10,000 or that 0.33 will earn you $33. However, in a high-yield savings account, that interest will be 4.88 or $488. So if you understand that, and I'll give you an example for me, I have a lot of my accounts at Bank of America. They don't have high-yield savings accounts, right? They just have a traditional savings account, so I could always move money between accounts. However, with a high-yield savings account, it's important to know that these interest rates are much more variable. Most traditional banks don't have them. Most of these are online, and they're less liquid when you begin to transfer from the high-yield account to your traditional bank account. It could take up to 3 to 5 days. It's important that you understand this. And yeah, there's going to be a higher minimum balance, but for the folks that are out there that are not only saving their money properly, they have excess money, and they don't want to earn a pittance on 0.33% interest, this is a play that you may want to consider as you step into that next wave of financial freedom, because now you're really studying the art of interest rates. All right, folks, it's time for the surf and turf. Get ready to rumble, because this is what's going to really bring all this stuff together and put you in a different mindset. If we look at money in a high yield savings account, yes, that's 4.x%. If we look at money in the greatest chart since 1980, yes, that's north of 10% according to the average rate of return. But both scenarios are singular to their product. There's no multiplicity to that. So what I offer you, I grew up in a scarcity money mindset in Bayonne, New Jersey. We didn't know about velocity. We didn't know about leverage, liquidity, and control. Here's where we have been able to take that next step forward, and that's by overfunding a cash value, high dividend paying life insurance plan, which not only allows for the guarantees inside that policy, which are very conservative. Guarantee plus dividend is anywhere between 3 and 5%. That's just a protection vehicle, but it's how you take that money outside of that policy while it's earning that 3 to 5, while you're getting protection from disability, death, lawsuit, inflation, and interest rates, and now it's earning a rate of return in real estate. Now it's earning a rate of return in business. Now it's earning a rate of return in financing your own debt. Now it's earning a rate of return if you're going to consult for equity. Those are multiple rates of return off the same dollar that you cannot do if all your money's in an S&P fund or if it's all in a savings account. Anyway, if you want to learn more, go ahead, click the link below. One of the experts here at Epic will take you through the success process. There's no obligation on your part. They'll answer any questions, and think of it like a map. You have a destination. You really got to learn where you are. The folks here at Epic will show you where you are and how to get to that destination. Thanks for checking us out, and stay tuned.